Can specific land valuation methods reduce farmland capital gains? Imagine selling a piece of farmland and wondering if there's a way to pay less in taxes. Well, certain land valuation methods and tax strategies can help lower your capital gains tax bill. Let's explore how this works. When you sell farmland, your capital gains tax depends on the difference between what you paid for the land and what you sell it for. The higher the sale price, the more tax you owe. But the way you value the land before selling can make a big difference. One common method is the income approach. This looks at how much money the land can generate, like rental income or crop profits. By estimating future earnings and discounting them to today's value, you get a more realistic picture of its worth. If the land isn't producing much income, this method might show a lower value, which can reduce your capital gains. Another method is the asset approach. This considers the value of the land along with buildings and equipment on it. If you have expensive improvements, this can increase the land's value and your potential tax. But if you focus on the land itself and ignore improvements, you might get a lower valuation. The market approach compares your farmland to similar properties recently sold nearby. Adjustments are made for differences in size, location, and features. If comparable sales are lower, your land's value drops, which can lower your capital gains tax. Discounts can also help. Marketability discounts account for farmland's lower liquidity compared to other assets. Usually, a 15 to 35% discount is applied to reflect this. If you own only part of the land, a minority interest discount might lower the valuation further. Legal tools can also make a difference. For example, if you inherit farmland, its basis is stepped up to current market value, which can significantly reduce gains if you sell soon after. Using trusts or family entities to hold the land can also create valuation discounts and simplify transfer processes. Tax strategies like the 1031 like-kind exchange let you reinvest sale proceeds into similar property, deferring taxes. Deferred sales trusts and installment sales spread out the gains over time, reducing your yearly tax burden. In practice, choosing an income-based valuation with discounts, adding capital improvements to your basis, or using legal structures can lower your taxable gains. Combining these methods with tax deferral strategies can help you keep more of your money when selling farmland. So, yes, specific land valuation methods and smart tax planning can reduce the amount of capital gains tax you owe. Understanding these options can help you make better decisions and grow your farmland investments more effectively.